Good afternoon. My name is Kent Skornia, President and CEO of Krilogy. I'm here with my partner, John McArthur, Chief Investment Officer of Krilogy, and this is your October market update. So, John, we like to spend a few minutes every month just sort of recapping what's happened with the market, also try to, sort of figure out what's going on with the economy. And, this is quite a few months. I'm going to read off some stats here. So in May, we were basically flat. In June, we were off 8%. July, we're up 9%. August, we're down 4%. September, now 9%. And then now October up, a pretty substantial amount, maybe 8-9%. So, I think the only thing we can sort of get from that is volatility, right? I mean, we are in the heart of what is a challenging environment, and you're not sure exactly where everything's going. So what are you seeing out there from your team and from the investors?
We are in the thick of volatility for certain, as we all know, as investors ourselves. I think it's from a market perspective, I think it's a bottoming process. You hear that a lot, I think probably in the financial media, but it's true. You've seen extreme ups, extreme downs, just about the time that many wanted to maybe capitulate or exit the market in June. We get a 23-day, 16% advance.
Crazy, right?
In really short order. And that's what happens in bear markets. I think, we're reminded that this process takes time, but that also that the market's looking out in advance and tends to anticipate the economic turbulence that's ahead of us, and frankly, a recession at this point is looking much more like a base case expectation. We're seeing some indicators on a very recent basis, which help support that. In fact, just yesterday we saw the 3-month Treasury on a market closing basis invert relative to the 10-year, meaning the yield on the 3-year is higher than the 10-year, and
that's a pretty big indication that recession's coming.
That's been a historically accurate one. In fact, it's been more accurate than the 2-year, 10-year inversion that you hear often talked about in the media. So that just happened. That's a pretty good tell. Typically, that could take a year or so, give or take.
Because there's no guarantee of when that recession comes. It's
right.
A pretty good indicator.
Pretty good lead indicator.
Correct.
COVID period, it took a month, but normal periods, we're talking a year plus.
Right.
So that happened. A 6-month rate of change in leading economic indicators. That's rolled over to the tune of -5% or so. That's a pretty good indicator in the last 7 or 8 recessions. So I think the evidence is there. I think we need to separate the economic conversation, though, from a market conversation.
Because they are disjointed, right? In terms of time, right? The market is a predictor of future earnings. And obviously earnings are a result of what's happening in the economy. But the market is a predictor. The economy is actually real life.
That's exactly right.
So talk to us about, we've been hearing about the Fed.
Right.
This is all the markets talk about at the moment, is the Fed, the Fed, the Fed. Where is the Fed on their rate hiking journey? What are you all seeing in your research?
I don't think they can communicate this quite yet, but it would seem as if they're getting certainly closer to the end. I think a period of pause and reassessing is closer than perhaps the market is expecting at this point, or maybe the market is starting to expect it, as we've seen in advance here over the last few weeks. But Bank of Canada just raised rates by 50 basis points, and the expectation had been 75. We haven't seen that really talked about in a mainstream type of way, but that's, all of a sudden you're seeing the Bank of Canada do a little bit less. You're seeing intervention by the Bank of England, the Bank of Japan, and so, that brings about these concerns around systemic risk and financial stability, which is front and center for the Fed. I think if we zoom out a little bit and recognize, national debt is 31 trillion and there's 8 to 9 trillion on the Fed balance sheet, the system can't withstand high rates for an extended period of time. If we just
and particularly as fast as they've come, they've really slammed on the brakes. I always love to reference the business owners that we work with here at Krilogy and the conversations we're having, and those business owners today that have that carry inventory,
Absolutely.
particularly in steel or in commodities. It will. They have seen prices fall pretty dramatically in a pretty rapid pace, which says a lot about what's happening as a result of what the Fed is doing.
Right. That's a great point. And the economic impact of the rate hikes is just starting to show up.
Yeah.
We're seeing, you mentioned commodities. I mean, the commodity prices are starting to roll or have continued to roll over. We're seeing the housing market with 7% 30-year mortgages. That is creating a standstill on the housing front. Purchasing Managers Index, the flash PMI numbers for October were the second worst since 09.
Yeah.
So there continues to be increasing evidence that it's having impact, and you could argue that we're in earlier days of that impact. So I think as time goes on, the data will continue to show the impact from historic rate hikes. I mean, the 2-year Treasury, as it relates to borrowing costs and so forth, the 2-year Treasury was at 75 basis points at the beginning of the year, end of last year, hit 450, 460, 450 basis points. I mean, that's an incredible rise, historic actually.
Unprecedented, right?
It's unprecedented. We've not moved this far this fast ever. And so I think there's going to be a pause to reassess at some point.
Isn't it interesting now that you're modeling out portfolios, how different it is for a retiree today looking to create income? Now, obviously, inflation is something to consider.
Yeah.
But when you're looking at 2 to 3 to 4% yield, when for years our retirees had such a challenging time of finding yield because the Fed was just pushing them to more risky assets.
Right.
Walk us through what you guys, the adjustments you made.
I think there's complacency risk there, though. I think investors that have intermediate to long dated treasuries certainly have felt significant pain. I mean, the long bond is down 30% plus year to date.
Right.
So this is not the time to abort, by the way, in your traditional 60-40 portfolio, which has had a historically bad start for the first 9 months of the year. You're right. So that you can get yield on a shorter term basis without question, so that shorter term treasury ladder is attractive. It wasn't an option for a long time, but as the inflation data will continue to roll over, if the economy continues to soften at sharp magnitudes, that rate structure is going to change. In fact, I mean, we saw the 10-year hit 4.25 here in the last week. It's at 3.9 today. So there's a lot of volatility in the bond market. But yes, fixed income is an option again. And I would contend that if the recessionary narrative plays out in whatever time frame, perhaps Q1 of 23, maybe Q2, we're going to see the yields go down. And so if you're a buyer,
how the Fed's going to fight it, right?
That's right.
Yeah.
If you're a buyer of intermediate treasuries even, I mean, you've got the potential for not only yield, but potential appreciation if the 10-year sits back down to 3%, give or take, maybe a little bit more, maybe less, but
best of both worlds.
Yeah, and I think it lends itself to, and we've had this conversation before about alternative investments, private market exposure. Again, there's some trade-offs. You can talk with your advisor more in depth, but it's been a tremendous place to be. I think, when we look at our short list of approved private market alternative funds, there are varying degrees of positive year to date. Many of them are cash flow oriented. They've made a significant difference in portfolio construction, and
it helps out in lowering the volatility.
It
right?
does, for
creating
sure.
yield, consistent income.
Yeah.
Just different ways. So talk to us about earnings, right? So stock market earnings. What are you seeing so far this season?
Yeah, I think
this quarter.
I think the summary line is much better than feared. I think if we look at a top line basis, we're seeing both actually top and bottom line. We're seeing companies beat. 37% have reported so far. We're seeing companies beat by 70% on a top line and body, or 70% of them are beating on a top line and bottom line perspective, roughly. Median outperformance in earnings versus expectations is about 5% top line and 3% bottom line, respectively. So much better than feared. You could argue that it's going to take some time to continue to show up. And so if we kind of look like big picture here at the earnings backdrop, the S&P did about 208 in earnings for 2021. Expectation for this year is about $220 in earnings. So, even if we continue to see this slowdown in earnings expectations, at the beginning of the year, 2023, earnings were about $250. That's come down to about $235.
Right.
Even if we fall further, let's call it 220, you start to look at market price over earnings, so 3,800 roughly on the S&P over 220. It's a 17 times multiple, very fair. In a worse than that type of situation, 3,300 over 220, you're looking at a 15 times PE. So again, we're dancing around the bottom, I would contend, from a market perspective.
All of those calculations that you just did in his head are indications that the market is close, potentially close, but we can't guarantee that.
Yep.
We don't want to predict it.
Yep.
And it's all about fundamentals in your investing and your process of building out your portfolio. I think that's what's
important. Yeah.
This volatility, what I read off earlier, flat, down 9, plus 9, down 9, plus 10 in these last few months, it really challenges our emotions when we're investing.
It does.
And you and I have been investing clients' money for a long time.
Several decades. Yeah.
Several decades. Talk to us about how you guys work through the process to eliminate that emotional piece.
Yeah, the portfolio construction part of the process and discussion with individuals and families that we work with is critical, because we need to quantify what supplemental income needs look like, what volatility of the entire portfolio looks like. It's much less about the components, but about the aggregate, and dampening volatility, lowering correlation, looking at valuations and expected returns out of the various segments. I think in this kind of cycle turnover, it's just a great opportunity to reassess what you own. We've been from this high growth, even non-profitable segment of the market that worked for a number of years, and inflation and Fed policy has swung the pendulum in the other direction. And so, very quietly, even on a several month basis, looking backwards, we're seeing so many sectors and industries that have been unloved for much of this last cycle, going back to 2009, industrials and materials and energy.
Right. Yeah.
It's your classic value type of sectors that are really performing quite well. We saw it anecdotally with earnings reports before the open this morning. And so I would caution folks to anchor on what worked in the past is going to be leadership going forward, because I'm not so certain it is. We're in a different environment.
Absolutely. Anything else out there that you're saying that you'd like to?
Yeah, I think from a takeaway perspective, there's a lot of narrative around this decline in earnings, and a lot of the big investment banks are saying, get ready, we're going to continue to see a ratchet down in earnings. And that very well may be true. That's something we're mindful of and are assessing when we model our work. However, if we look at outside of the tech bubble, if we look at the last 7 or 8 recessions, the market bottomed well in advance of the ultimate decline in earnings. And that's really, really important. On average, again, it's going to vary given the recession, but as much as a year in advance. Again, the outlier there was the tech bubble, where the market didn't bottom until after earnings decline, but that's an anomaly. I think typically you're going to see the market anticipate that max trough in earnings as well as economic data before things advance. The market will do that in advance is the bottom line.
Yeah, because typically, on earnings calls, those company leaders will tell.
That's right.
We'll give the tale of what's happening here in the future.
That's right.
They're not going to try to surprise anybody.
They're going to probably seek to under-promise and over-deliver, generally speaking.
Right.
I think from the other thing I would encourage investors to just be mindful of is we are literally approaching seasonally. I have to take this with a grain of salt, but in this midterm election period of a 4-year cycle, this has historically been the best period we're entering. So using November 1st as a proxy through April, the last 18 midterm election periods, November 1 to the end of April, all 18 have been positive for the S&P 500, and the average return in that period is 15% or greater. So again, It's not a statement to say that that's going to happen this time, but given the backdrop of the negativity and pessimism and market pain we've felt, I would suggest that the odds are more probable than not that we've got sunnier skies ahead in the market.
And it's always challenging to watch the news and listen to what's happening currently today in the market, and yet hear a stat like that and still have faith to go make something happen. That's why it's really critical for you to sit down with your wealth advisor and spend some time with your portfolio, understanding exactly what's in there, why it's in there, the process that was put in place in order to get those holdings placed inside your portfolio, what that is doing and how it's interacting with your wealth plan. Because ultimately, all we care about is accomplishing the goals that you've set forth. So for John McArthur, I'm Kent Skornia. Thank you for your time. And as always, we appreciate the opportunity to be stewards of your wealth. Have a great day.